Hi everyone, my name is Robin Speziale and I am the national best-selling author of a book called Market Masters. So in this video, I'll be talking about Warren Buffett and more specifically, what's called the owner's manual. And Buffett actually typed up this owner's manual and he has it on his website, berkshirehathaway.com. If you haven't gone to Berkshire Hathaway, it looks like it was obviously programmed in basic HTML all the way in the 90s, but it hasn't been updated since then. So take a look with me. If you go to Google, type in Berkshire Hathaway, or in your URL bar at the top of your browser, type in berkshirehathaway.com, which is Warren Buffett's company. Once you go to the home page, you'll see a bunch of just plain HTML links. On the left side of berkshirehathaway.com, there's a link near the end there on the left called Owner's Manual. And when you click on Owner's Manual, you'll get a PDF open up. And this list of principles that Warren Buffett has put a lot of thought into, and he's sharing with not only his shareholders, but he's sharing with the possible future prospects. So these businesses that he might be buying in the future. And this really puts you in the mind of Buffett and what types of companies, what type of management, what type of qualities that he looks for in his investments. And I read this a couple of years ago, actually years ago when I was around 18, 19, 20. But it really helped me formulate, my philosophy of what to look for in companies I invested in the public markets, whether they're on the New York Stock Exchange or the TSX, US or Canadian company. And so I'm going to go through this list, but first I'll reiterate what he says up here at the top, and these are in Buffett's own words. So he says that in June 1996, we issued a booklet entitled An Owner's Manual to Berkshire's Class A and Class B shareholders. The purpose of the manual was to explain Berkshire's broad economic principles of operation. An updated version is reproduced on this and the following pages. But what you'll find is not just principles on Berkshire Hathaway, but principles that he looks for in other companies as well. And this can help you as a do-it-yourself investor when you're scouring companies to invest in on the stock exchange. So here he says, at the time of the blue chip merger in 1983, I set down 13 owner-related business principles that I thought would help new shareholders understand our managerial approach. As is appropriate for principles, all 13 remain alive and well today, and they are stated here in italics. So principle number 1, Buffett says, although our form is corporate, our attitude is partnership. Charlie Munger and I think of our shareholders as owner partners and of ourselves as managing partners. Because of the size of our shareholders, we are also, for better or worse, controlling partners. We do not view the company itself as the ultimate owner of our business assets, but instead view the company as a conduit through which our shareholders own the assets. Principle number 2. In line with Berkshire's owner orientation, most of our directors have a major portion of their net worth invested in the company. We eat our own cooking. Number 3, Buffett says, our long-term economic goal, subject to some qualifications mentioned later, is to maximize Berkshire's average annual rate of gain in intrinsic value on a per-share basis. We do not measure the economic significance or performance of Berkshire by its size. We measure by share progress, by per-share progress. So instead of looking at, here's an aside, at net income, he would look at what is the earnings per share. Instead of just book value, he looks at, okay, what's the book value per share? What does it mean for shareholders? Back to Buffett. He says, we are certain that the rate of per share progress will diminish in the future. A greatly enlarged capital base will see to that, but we will be disappointed if our rate does not exceed that of the average large American corporation. Okay, so this is Buffett's principle number 4 in his owner's manual. Our preference would be to reach our goal by directly owning a diversified group of businesses that generate cash and consistently earn above average rates on capital. Our second choice is to own parts of similar businesses, attained primarily through purchases of marketable common stocks by our insurance subsidiaries. The price and availability of businesses and the need for insurance capital determine any given year's capital allocation. Principle number 5, Buffett says, because of our two-pronged approach, to business ownership, and because of the limitations of conventional accounting, consolidated reported earnings may reveal relatively little about our true economic performance. Charlie Munger and I, both as owners and managers, virtually ignore such consolidated numbers. However, we will also report to you the earnings of each major business we control, numbers we consider of great importance. These figures, along with other information we will supply about the individual businesses, should generally aid you in making judgments about them. Here's Buffett's principle number 6. Accounting consequences do not influence our operating or capital allocation decisions. When acquisition costs are similar, we much prefer to purchase $2 of earnings that is not reportable by us under standard accounting principles than to purchase $1 of earnings that is reportable. This is precisely the choice that often faces us, since entire businesses whose earnings will be fully reportable frequently sell for double the pro rata price of small portions whose earnings will be largely unreportable. In aggregate and over time, we expected unreported earnings to be fully reflected in our intrinsic business value through capital gains. Here's Buffett's principle number 7 in his owner's manual. We use debt sparingly, and when we do borrow, we attempt to structure our loans on a long-term fixed rate basis. We will reject interesting opportunities rather than over-leverage our balance sheet. This conservatism has penalized our results, but is the only behavior that leaves us comfortable, considering our fiduciary obligations to policyholders, lenders, and the main equity holders who have committed unusually large portions of their net worth to our care. As one of the Indianapolis 500 winners said, to finish first, you must first finish. Principle number 8. Buffett says a managerial wish list will not be filled at shareholder expense. We will not diversify by purchasing entire businesses at controlled prices that ignore long-term economic consequences to our shareholders. We will only do with your money what we would do with our own, weighing fully the values you can attain by diversifying your own portfolios through direct purchases in the stock market. Principle number 9, we feel noble intentions should be checked periodically against results. We test the wisdom of retaining earnings by assessing whether retention over time delivers shareholders at least $1 of market value for each $1 retained. To date, this test has been met. We will continue to apply it on a 5-year rolling basis. As our net worth grows, it is more difficult to use retained earnings wisely. Principle number 10. We will issue common stock only when we receive as much in business value as we give. This rule applies to all forms of issuance, not only mergers or public stock offerings, but stock for debt swaps, stock options, and convertible securities as well. We will not sell small portions of your company, and that is what the issuance of shares amounts to, on a basis inconsistent with the value of the entire enterprise. You should be fully aware of one attitude Charlie and I share that hurts our financial performance. Regardless of price, we have no interest at all in selling any good business that Berkshire owns. We are also very reluctant to sell subpar businesses as long as we expect them to generate at least some cash and as long as we feel good about their managers and labor relations. We hope not to repeat the capital allocation mistakes that led us into such subpar businesses, and we react with great caution to suggestions that our poor businesses can be restored to satisfactory profitability by major capital expenditures. The projections will be dazzling and the advocates sincere, but in the end, major additional investment in a terrible industry usually is about as rewarding as struggling in quicksand. Nevertheless, gin and rummy managerial behavior, discard your least promising businesses at each turn, is not our style. We would rather have our overall results penalized a bit than engaged in that kind of behavior. Warren Buffett's principle number 12 in the owner's manual at berkshirehathaway.com. Number 12, we will be candid in our reporting to you, emphasizing the pluses and minuses important in appraising business value. Our guidelines is to tell you the business facts that we would want to know if our positions were reversed. We owe you no less. Moreover, as a company with a major communications business, it would be inexcusable for us to apply lesser standards of accuracy, balance, and incisiveness when reporting on ourselves than we would expect our news people to apply when reporting on others. We also believe candor benefits us as managers. The CEO who misleads others in public may eventually mislead himself in private. Okay, so now principle number 12, and again, this is in the owner's manual, Berkshire Hathaway, as told by Warren Buffett. We will be candid. Actually, number 13. Despite our policy of candor, we will discuss our activities and marketable securities only to the extent legally required. Good investment ideas are rare, valuable, and subject to competitive appropriation, just as good product or business acquisitions ideas are. Therefore, we normally will not talk about our investment ideas. This ban extends even to securities we have sold, because we may have purchased them again, and to stocks we are incorrectly rumored to be buying. If we deny those reports but say no comment on other occasions, the no comments become confirmation. So 2 added principles to the owner's manual by Buffett. Number 14, to the extent possible, we would like each Berkshire shareholder to record a gain or loss in market value during his period of ownership that is proportional to the gain or loss in per share intrinsic value recorded by the company during that holding period. For this to come about, the relationship between the intrinsic value and the market price of a Berkshire share would need to remain constant, and by our preferences at 1-to-1, as that implies we would rather see Berkshire stock price at a fair level than a high level. Obviously, Charlie Munger and I can't control Berkshire's price, but by our policies and communications, we can encourage informed, rational behavior by owners that in turn will tend to produce a stock price that is also rational. Our "it's as bad to be overvalued as to be undervalued" approach may disappoint some shareholders. We believe, however, that it affords Berkshire the best prospects of attracting long-term investors who seek to profit from the progress of the company rather than from the investment mistakes of their partners. And finally, number 15 in the owner's manual, Buffett says, we regularly compare the gain in Berkshire's per share book value to the performance of the S&P 500. Over time, we hope to outpace that yardstick. Otherwise, why do our investors need us? The measurement, however, has certain shortcomings that are described in the next section. Moreover, it is now less meaningful on a year-to-year basis than was formerly the case. That is because our equity holdings, whose value tends to move with the S&P 500, are a far smaller portion of our net worth than they were in the earlier years. Additionally, gains in the S&P stocks are counted in full in calculating that index, whereas gains in Berkshire's equity holdings are counted as 65% because of the federal tax we incur. We therefore expect to outperform the S&P in lackluster years for the stock market and underperform when the market has a strong year. So to sum up, this was Warren Buffett's owner's manual that he wrote years ago, and he's posted on BerkshireHathaway.com. And it's not very well known that Buffett's posted this owner's manual, and it's really a glimpse into how Buffett thinks about his own company, how he wants to run it, and how devoted he is to shareholders. Right, he's about creating wealth for his shareholders, who he regularly calls his partners. And this owner's manual is actually also a blueprint that Buffett uses to go out in the stock market to invest in stocks. And it's also a blueprint he uses to invest in all the private companies he has under Berkshire Hathaway. For example, he fully owns Fruit of the Loom, he owns Dairy Queen, he owns the Nebraska Furniture Mart, and he owns a slew of other businesses across many industries that he understands. And this is, in my mind, one of the best blueprints in Warren Buffett's thinking, this owner's manual on BerkshireHathaway.com. The other amazing blueprint you can read are Buffett's early partnership letters, which he was writing before he bought Berkshire Hathaway and started running that as his own holding company and entity as a publicly traded stock. So look up Buffett's partnership letters as well that he wrote. He was really, he was very much a hedge fund manager back then, and he had some great ideas on investing. So I'm glad you enjoyed this, guys. Check out the owner's manual on BerkshireHathaway.com, and happy investing. Talk soon.